I'll be frank, talking about a stock shouldn't be like talking about politics. Yet that's precisely what's happened with EV giant Tesla. Because of the cult of personality surrounding the company's enigmatic CEO, Elon Musk, discussing this company honestly has become extremely difficult. Even some of the biggest market insiders can't criticize the company without getting bashed by Tesla, or rather Musk devotees. While I and many market analysts have repeatedly warned investors about Tesla's mounting problems, we were mostly met with accusations that we simply didn't like Musk or needed to get with the program. Well, on January 25th, shares of the EV company dropped 26%, wiping out a whopping $205 billion in market valuation. So if you finally want to talk about the fact that Tesla is in trouble, this video is for you. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. Regardless of what you think of Musk or the company itself, it's hard to deny that Tesla is facing a steep decline in its market performance. And keep in mind, I completely acknowledge that Tesla is one of the biggest and most important car companies, electric or otherwise, to come out in the past 30 years. However, this most recent downturn is the company's worst since 2016. To give you an idea of just how crucial that is, the iconic Model 3 hadn't even been released yet. And like all major stock drops, such a decline raises serious questions about the company's current valuation and future trajectory, especially in the context of a rapidly evolving EV market and increasing competition. The problem, as I hinted at in the introduction, is that too many people don't want to have these conversations. But in the end, the markets don't move based on your feelings or mine, or Musk's for that matter. Markets move based on sentiment, economic indicators, industry performance, and earnings reports. So let's take a look at which of these are currently proving so problematic for Tesla. Shocking news for EV investors. Last Thursday proved to be a watershed moment for Tesla investors, with the company's shares tumbling over 10% following an underwhelming earnings report. The report indicated a mere 3% revenue growth in the fourth quarter of 2023. Meanwhile, auto revenue increased by a mere 1%. These aren't the sort of numbers that investors or the market at large expect from a pioneering company in a fast-growing field. This being the case, the markets reacted accordingly. I think Adam Sarhan of 50 Park Investments put it best when he said, if Tesla is lowering its forecast and is not bullish in the near term, why should investors be bullish? It's a good question and speaks to the sort of logic that is sorely missing regarding this stock and others like it. You see, on top of the lackluster earnings, Tesla also noted that volume growth for 2024 would be notably lower than what we saw last year. This projection, which indicates a potential deceleration in Tesla's business, has sparked widespread unease among investors and market analysts. Many are pulling out before things get worse, while others are holding but not exactly happy about it. In fact, at least two major analysts have downgraded the stock, while several have cut their price targets on the stock. So what's behind all this? Tesla has a long history of making very bold promises. In a fast-moving industry like electric vehicles, you have to expect that sort of thing. But when you overpromise and underdeliver too much, it tends to cause problems. So let's take a closer look where Tesla may have erred in the past year or so. We'll start with the Cybertruck. This is perhaps the most polarizing vehicle design since Homer Simpson's long-lost brother let him create his own car. And despite being the brainchild of Elon Musk's literal children, Tesla doubled down on making it the big release of the early 2020s. But after years of delays, it now seems that the Cybertruck is not just the ugly duckling of the car world, it's also seriously underperforming. Owners of the vehicle have reported that the actual range of their Cybertruck falls well below Tesla's advertised figures. In fact, in one instance, it traveled just 206 miles on a full charge and 164 miles at an 80% charge. These figures would be alarmingly low for any company, let alone one that prides itself on its superior range capabilities. Furthermore, Tesla's ambitious full self-driving initiative has been marred by safety concerns and regulatory scrutiny, which includes several notable incidents involving emergency vehicles. This is particularly frustrating for investors as Musk has been promising FSD will be ready every year for over a half decade. Finally, we have the oddly timed news that Musk and his crew are putting Tesla's core business of selling cars on the back burner to explore new sources of revenue. Examples include bipedal general-purpose robots and AI initiatives, both of which have investors scratching their heads, and frankly, I don't blame them. The marketplace is also changing. When it comes to the poor report numbers, you can't lay everything at the feet of Tesla's management. According to the latest industry reports, demand for EVs is plunging all around the world. In fact, rental car giant Hertz recently cut back on plans to expand its electric fleet, causing a ripple effect that has since affected both Tesla and Ford Motor Company. Reports indicate that EVs have mostly become the domain of wealthy, trendy consumers, but even they are now looking at hybrids over straight EVs. In Q4 2023, EV sales increased by just 1.3%. Meanwhile, dealerships report EVs sitting on their lots an average of 3 weeks longer than cars and trucks with traditional internal combustion engines. That said, the data still indicates that the EV market will grow, just not as fast as previously expected. And given the finicky nature of the average car buyer, we can't 100% rely on surveys to determine future success. So where's the disconnect here? Well, this is where we might have to look beyond Musk's skills as a CEO and examine his abilities to relate to his investors. Follow the facts, not Musk. To say that many Tesla investors are captivated by Musk's vision and leadership is a bit of an understatement. Tesla doesn't just have investors in the traditional sense, it also has people who can be most accurately be described as fans. Musk's recent maneuvers, including the controversial suggestion to spin off Tesla's AI division unless he can secure a significant ownership stake, have only added to the company's volatile narrative. The fact that he seems more focused on X, and politics of late doesn't help this, nor do his attempts to rebrand Tesla as an AI or robotics firm. But despite the cloud of negativity, there's speculation that Tesla stock might be poised for a rebound. At least the stock's current oversold status suggests a potential near-term recovery. However, much of Tesla's future stock performance hinges on Musk's actions and abilities to navigate its current challenges, and there are plenty of them. In short, Tesla needs a leader right now, and the leader it has is at best distracted and at worst completely disinterested in steadying the ship. Tesla's situation is a complex basket of market dynamics, internal issues, and leadership controversies. The company's trailblazing role in the EV industry is undeniable, but getting back on that path will not be easy. Both investors and market analysts will be watching Tesla's next moves very closely in the coming weeks. And given Musk's unpredictable management style and tendency to fly off the handle when put on the spot, we could see a lot more fireworks before we see a rebound. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.